All right. Get started going right now. Anna, looks like you get your own personal webinar. Seems like with the weather around the area, a lot of people are missing out. So I'll get started here. Please feel free with any questions that you have to just put it in the chat. But let's get started. So this webinar is I'm going to go over the 5 money mistakes that people make when buying their first home. We're going to go into a lot of details, and we'll start out here. The presentation, as I said, is going to cover the mistakes people make when obtaining a mortgage, certain mortgage features that can help you save money, options on how to book a time with me to talk. As I mentioned, there's going to be someone watching the chat feature for questions. And we'll have a few breaks along the way. So if you think of something, put it in the chat and I'll reply as we get to those steps. A little bit of information, just a little bit about me and my company. My name's Rob Miller. I'm the branch manager and senior loan officer with Provisor Incorporated Transparent Mortgage Solutions. I've been in the industry going on 26 years now. The company I work with is Provisor Transparent Mortgage Solutions. We are a Wisconsin-based company, started in 1998 in Madison, Wisconsin, by James Mercado. He's still our company's president. We have locations throughout South Central, Southeastern Wisconsin, Madison, Milwaukee, Watertown, and the East Troy area. Every year we fund over 1,000 loans. So we definitely have some business that we do, and we've seen a lot. So things that I truly believe, these are things that I live by. The main skill that you should look for when buying a home and working with a mortgage company and a particular loan officer is to make sure you work with someone who is set up, knows the rules, and is going to be a good problem solver. Is going to be able to figure out what you're looking to do, what you're looking to accomplish, and figure out the best and least expensive ways to get there. Our lives have hurdles. A loan officer's job is knowing how to guide you through those hurdles and solve problems. That is really the biggest key to obtaining the correct mortgage that's going to work for you. Bit of information more about me. I have a few of my online reviews I've listed. If you want to look me up, you can type in a Google search, either Mad City Home Loans or Rob Miller Provisor. Either one will get you, and you'll be able to look up some of my my reviews and some of the clients I've worked with. Learn a little bit more about me. Let's dive right into it. The first mistake that people make when obtaining a mortgage is not using a lender who's going to offer all the different mortgage options. There's a lot of different options that are out there. Some of them are listed on this page. We have a conventional loan. We have a VA loan. We have a USDA loan. We have an FHA loan. We also have a WIDA loan, which is a Wisconsin-specific loan. We have non-qualified mortgage loans, which are loans for people that are maybe self-employed or can't really prove their income. They're looking to purchase a non-warrantable condominium, some interesting things out there. Adjustable rate mortgages, people that are trying to get into a property with the lowest possible interest rate, and an adjustable rate mortgage may help them get into that at a lower interest rate. However, an adjustable rate mortgage is not like a standard fixed rate mortgage. A fixed rate mortgage is going to be once you close, once you buy, it's going to be exactly the same interest rate for the whole life of the loan. An adjustable rate mortgage is going to have a shortened period of time, whether it's 3, 5, or 7 or 10 years, where it's fixed. And then after that, it adjusts based on the current market. Another type of loan that some people use, not generally speaking first-time home buyers, but some buyers use, are jumbo loans. Jumbo loans are going to be homes that are very pricey homes that are going to have loan amounts that are going to be higher than the limit that's listed here of $647,200. Going back to conventional loans, VA loans, USDA loans, and FHA loans. There's different types. You might fit into all the categories. You might fit into one. You might fit into two of these categories. We have all of these loan programs available for people. Conventional loans are loans that are going to require a 3% down payment. Not really a maximum debt to income ratio. You don't have to worry about that. A little bit higher credit score requirements. VA loans are another option. Now, they're a no money down program. However, the no money down program is designed, the VA loan program is designed just for veterans. USDA loan is also a no money down loan. But again, they are going to have certain restrictions as to whether or not you can qualify for that. Income restrictions and where the property is located. Generally speaking, USDA loans, another word for them is called a rural development loan. So they're going to want you to be in a more rural community. FHA loans, they're going to be kind of the catch-all. If you're going to qualify for a mortgage, you're definitely going to qualify for an FHA loan. They have very low credit score requirements, higher debt to income ratio, so you can technically afford more of a home than what is listed. But they do have a minimum down payment of 3.5%. WIDA loans, on the other hand, again, just like USDA, WIDA loans are going to be a no money down mortgage. They are going to allow you to get in without having to put any money down. They are going to have a little bit higher credit score requirement, but they are going to, excuse me, I'm admitting someone else. They are going to be restrictive on certain things. They're going to have a maximum income requirement as well. On to the next slide here. The official lending rules versus lender overlays. You're going to want to make sure that you work with someone who is going to know the differences between both. The rules for a loan type that come from the rules, they come from FHA, VA, USDA, Fannie and Freddie, Mac, which are the conventional lenders. They're going to be the exact same for every single lender that is out there. However, each individual lender that you work with or talk to may have overlays, and what that means is they are maybe a little adverse, or they don't want to tolerate certain risk that they might have. So someone might tell you that you can't qualify with a 600 credit score because they have an overlay that says you have to be over a 620 credit score. But you want to make sure that you're working with someone who's going to be able to look at all the different options. And of course, truthfully, this is why when you go to one particular lender versus another, just because one person says you can't do it doesn't mean it's not a possibility. Now, my company and how we work is we do not have overlays. We go directly to whatever Fannie and Freddie, FHA, VA, and USDA say. So we don't have particular overlays. So if you've been turned down in the past, that is something that we can certainly look at and see what we can get to qualify you. House types. Mortgages are going to be based on different house types. These are the general type of house loans that are out there. Single family homes where just one person lives in one of the units. It can be anywhere from a single family to a duplex to a triplex to a quadplex, where you live in one of the units. There's also condominiums, manufactured homes that are manufactured in a factory and then delivered to a site. New construction, where you buy a property and then you have someone construct a home on top of it. We have investment properties where you're not actually going to live in the property, but you're going to rent it out. Vacation homes or second homes, both really the same thing, where you're going to, stay there sometime, but not all the time. You really have a primary residence. I forgot to mention this at the beginning. You can actually see my information down here at the bottom in my contact info. However, I also have a QR code that if you take your phone and you put it up to the screen, you can actually download the QR code, which will give you all my information. Going on to the next slide, this is the end of mistake number 1. Any questions that anyone has, please certainly feel free to include those questions in the chat feature. I set up at the very beginning contact information. If there's something that you want to discuss, but you don't want to discuss during the chat section, please feel free to schedule an appointment with my calendar. Of course, you can also email me or call me at any time. Okay, I don't see any questions, so we'll go on to make mistake number 2. Mistake number 2, ignoring sources available for down payment and fees. You want to make sure that you know all the different options that are available for you. There's a lot of different options for down payments. If you don't qualify for the no money down program and you need a down payment, you can use any of these sources. You can use your own money, of course. You can get a gift from a family member, a friend, or an employer, or even a charitable organization. There are some that are out there. Down payment assistance programs, a loan or a grant. Those are things that I can certainly chat with you about, the different ones that are available in your area. We would want to know, have a simple conversation to figure out where you're at. We also have specific grant and down payment assistance programs that are available for people in what we call the Hero Home Program. And the Hero Home Program is going to be designed, and there's special grants for people that work in public service, whether it's the police, the fire, EMS, doctors, nurses, teachers, or even in healthcare, or even in just education in general. You don't necessarily have to be a teacher. You could be just an office administrator at a school. There are special programs for people like that. If you have another house, you could take out a second mortgage on that house for down payment purposes. Again, you can also use the sale of a current home. So if you're going to use your home and the equity in your home, you can use that for down payment. You can secure a loan on some asset that you might have, whether it's a life insurance policy, or you have a car that you want to, you don't owe anything on, and you want to go ahead and get a loan out against that. You can use that. The only thing that you really cannot use is just straight up personal loans for down payments. So you can't go out to Sophie or Lending Club or any of those online places and get a personal loan for down payment. You can sell property that you own, whether it's automobiles, guitars, art, guns, jewelry, whatever. You can use that as long as you can provide proof of that asset itself. Things you can't use, however, is you can't use cash that you have. Unless, of course, you've deposited into your account months and months in advance. Generally speaking, we need 60-day history of your bank account. So you want to make sure that if you have cash, you get it into the bank as soon as possible. You don't want to put it in 2 weeks before closing, because that's not something that we can use. And that's the sources of down payments. Closing costs and prepaids are fees that you use when you buy a home. When you buy a home or you refinance a current mortgage, there are costs, just like there's costs for any other purchase in life. When people hear that closing costs and prepaids can be $3,000, $6,000, $8,000+, they think that's a lot of money, and yes, it is. But when you understand what each fee does to help you buy a home, it makes more sense why they're charged. This is a very elementary example, but let's compare obtaining a mortgage to buying candy bars, Snickers bars at the grocery store. If you buy a $100,000 home, the closing costs probably close to about $4,500. When you buy candy bar, you're going to pay sales tax, 5.5% in Dane County, 6% in Milwaukee County. So if you bought that same $100,000 worth of Snickers bars, the taxes or the fees that you'd pay would be $5,500, which means it costs more to buy Snickers than it is to buy a house in numbers. What makes up closing costs? Closing costs are made up of the following information here. Some things may not apply, but you're always going to have an appraisal. It's going to make sure that the property
we're going to establish the value of the property. We're going to have a processing fee and underwriting fees. That's the time that the work time for the people that go through all the paperwork to make sure that you get all your verifications that we need and all the behind the scenes stuff. If your house is determined to be in a floodplain, we're going to order a flood certification to find out what it is. And this is on the home you're buying. There's a credit report that needs to be done. Obviously, we want to know where our credit is. We want to know what your debts are. So there is a fee that is going to be charged on that. Verification fees. If you're buying a condominium, we would need to have a verification of the condominium association. We may need to order an employment verification where they charge a fee. Lender's title policy fee. Lender's title policy is an insurance policy that's going to ensure that the mortgage is going to be free of any other liens. So you're buying the house free and clear. The person that's selling it to you is going to owe nothing when you take it over. Government recording fees. Government recording fees are just fees that they're going to charge to record the deed and the mortgage with the county that you own, that you're owning this home in. Discount points or discount fees are fees that you're going to be charged to buy your interest rate down to get a lower one. We're going to discuss this in greater details on another slide coming up. There could be other fees, and it's going to really depend on your individual transaction. But all of these fees are going to be lumped into paid at closing, with the exception of one, and that's the appraisal fee. Once we order the appraisal, it becomes a charge and a cost, and so you're going to prepay an appraisal fee. Again, it's going to depend on where you're buying the property and what type of property it is, but you can expect the only fee for the mortgage that's going to be upfront is going to be the appraisal fee, and you can expect somewhere between $400 and $700 for that fee. That is the only fee you should ever have to pay in advance. If someone else talks to you and tells you there's going to be an application fee, you really want to hold off on that. Prepaid costs, also part of the closing costs section, but they are prepaid expenses that are paid in advance of when they're due. Daily interest. Daily interest is going to be lumped into closing, and it's going to be the interest on the loan from the day of closing to the end of that same month. Home insurance. You're going to pay the first year home insurance premium at closing up front. If you are in a floodplain, we're going to require that you have flood insurance, and the first year's premium for that is going to be paid at closing. And then, of course, a lot of cases we can set up, in most cases, without putting 20+% down. We're going to have to set up an escrow account. Now, an escrow account is like a savings account that's going to be set up, and you're going to pay your home insurance and you're going to pay your property taxes in every single month. Now, we're going to make sure that we have a little bit of a cushion, so if things change throughout the year, we have that updated. So we are going to set up an escrow account for you. Now, if you're buying a condominium, they're going to charge you the first month condo dues. Just like down payment, these closing costs and prepayment options can be paid by any of the things that we talked about before: your own money, down payment assistance, second mortgage, sale of your current home. However, you can also add to it, there are also two other options. You can ask the sellers for a credit to help offset those closing costs. That's something that we can coordinate with a real estate agent that you might be working with. Of course, there is also a lender credit that we can provide you. Just the exact opposite of discount points. A lender credit is you're going to go into the loan with a higher interest rate. And with that higher interest rate, we can provide you with a credit to help offset that, which would then help offset the closing costs. Other than that, that's pretty much it that's going to be built into the process. Does anyone have any questions? Certainly please feel free to put it in the chat function if you have any questions on that section. If you think of anything that comes along or anything more in depth that you want to talk about, please just put it in there and we'll get to it as we go through this. And at the very end, we'll have a little bit more time as well. Okay, no questions. On to mistake number 3 is not getting a pre-approval. Pre-approval to buy a home is going to be a very important thing. You're going to be set and you're going to be sure that you're going to be able to buy this home and you're going to get a pre-approval letter. So a pre-approval is when a lender like me gets the details about your financial credit history, your credit report and your income, and any money that you have for down payment, if that's needed. Then the information about each loan type is added to your file so that all the information can be run through a risk software program that we all use. The computer software is going to evaluate your pre-approval letter. The pre-approval answer is only as good as the information being put into the software. And truly, the art of being a loan officer is knowing the tendencies of the software so you can be guided through what it takes to be pre-approved. A pre-approval is going to identify the price range of the house you qualify for. It's going to estimate your monthly payment and what total investment you might need with down payment. It's going to identify all the loan programs that we talked about before that you may qualify for and what might fulfill your needs. And then, of course, you're going to walk out the door with a letter from the lender stating that we've checked your numbers and you're able to make an offer to buy a property. Any questions about pre-approvals? Okay, I don't see any. Mistake number 4, this is after you own a home. And that's not paying extra each month on your mortgage. If you can see this, it's a little small on the slides, but on my computer, but right here we have a option, a scenario, a $250,000 home. Now I put down a down payment of 5%, just kind of a general down payment. I put in the loan amount. I put in an interest rate that we had going, just to kind of give you an idea. Now interest rates have dropped a little bit, so it's a little bit less costly than what we see here. And then I put in a 30-year mortgage. So if you just make the minimum payments, that's what we have here. So we show the principal and interest, any extra payments that you make. So your total monthly payment. It's going to show over a 5-year period, a 10-year period, and the full 30-year period, how much interest you're going to pay. And then it's going to break down after 5 years, after 10 years, after 20 years, the breakdown. Now, if you look at option 2, if you pay just an extra $50 a month, and we go through all this, so instead of paying $1,501, you're going to pay $1,551. You're going to go from a 30-year mortgage to a 27-year mortgage. If you pay an extra $100, you're going to go down to a 25-year mortgage. And if you can afford the extra $200, you're going to go down to a 21-year mortgage. The biggest thing that you're going to see here is after 5 years, you're going to have interest of $74,000, whereas way over here, you're going to have interest of $72,006. So you're going to save yourself about $2,000 in interest in just 5 years. And then, of course, as you look here, the total interest over the life of the loan is about $100,000 you're going to save if you can afford that extra $200. Of course, as you go here, you're going to see your loan amount, what you're going to owe after 20 years, after 10 years. You're going to have a lot more equity in the home. So being able to consciously make extra payments is going to save you a ton of money, particularly if you can afford that extra $200 a month, which is comparatively not a ton of extra payment. Any questions on the section regarding making extra payments on your mortgage? Okay, I saw your head shake there, Anna. Thank you. Mistake number 5, working with a lender who doesn't understand the official lending rules and also how to solve and overcome problems as they arise. This can be the most costliest mistake of all when it comes to your money. If they are not able to overcome or solve problems while you're in the process, you have just spent money and you may have an issue with being able to get it. So if you don't have someone who's able to flip the script, find something else that's going to work for you, it's going to end up costing you a lot of money. You could end up paying a little bit more in interest. You could end up not even being able to buy because there's a problem with them. So someone who doesn't, working with a loan officer who doesn't have the experience, has not been in it long enough to know what they're doing, is going to be something that's going to cost you a lot. Other just general money mistakes when you buy a home. One thing that most lenders don't know about, and this is something that my company offers, that you want to always make sure you understand. This is a credit that you get as a first-time home buyer. It is called the Mortgage Credit Certificate. It's a great program for home buyers, military veterans, and if you're buying a house in a HUD designated area. That's something that we can figure out, and that would be more designed if you were buying a second or a third home. The Mortgage Credit Certificate is a federal government program that is entered as part of your federal income taxes, just like when you have an earned income credit or you have a child tax credit when you do your taxes. This program allows homeowners to claim a dollar for dollar tax credit of up to $2,000 for every year you own the home. So what that means is, think of, we're doing taxes now. Think of this. If you're used to getting $1,000 for a refund, if you have a home and you use this program, you're going to not just have $1,000, you're going to have an extra $2,000 on top of that. So you're going to get a $3,000 tax refund. It's a huge thing that's going to make up. It's just a phenomenal thing. And if you are not talking to someone that understands this program and uses this program to help people, especially first-time home buyers and veterans, this is just you're throwing $2,000 a year out the door. There is a fee that you do pay, and it's built into the closing. It's a one-time fee to start this program, and there is an income limit that you have to be under. But you can use it with all the home types. Maybe not jumbo loans, because you really have to make a lot of money and you're going to be over that income limit in order to qualify for a jumbo loan. You're going to want to make sure that you discuss this program with your lender and see if you qualify for it. If they don't know this program, you want to talk to someone else, because this is just something that is phenomenal and it's going to just give you a lot of extra money. Things that are going to affect your interest rate, which of course, the higher your interest rate, the more interest you're going to pay, the higher your payment's going to be, the more money you're going to lose over the life. Obviously, one of the most important things that is not part of the mortgage market that's going to affect your rate, and then therefore your monthly payment, is your credit score. The higher your credit score, the better your interest rate that you get. How much you're putting for a down payment, the type of property. So whether you're buying a single family home or an investment property, or you're buying a second home, or you're buying a condominium, whether or not you're not putting 20% down, you would need mortgage insurance, and that's an added cost that you're going to have on a monthly basis. And mortgage insurance is part of your total payment, and it's set up to help the lender to obtain an insurance policy that's going to help us in case of foreclosure. The loan amount, the amount of money you are borrowing, causes interest rates to be higher or lower. The higher your loan amount, the more interest us as lenders are going to make, so the lower your interest rate is. It's not a huge amount, but there's a little bit of difference there. The length of your loan, the longer it is, the more economic influences can affect our profitability. So the higher the interest rate. And then, of course, something that people don't know is, once you get a house and you get an application going and you're wanting to lock in your interest rate, the length of the actual interest rate lock. So how long are you going between locking that rate in so it doesn't change until actual closing? The longer that is, the higher the interest rate may be. Some pretty important thing, credit. One of the most important things to obtaining a mortgage. And some people talk about, and I talk to clients all the time about this. I ask them about what they think their credit is, and they use Credit Karma. And Credit Karma and some of the other ones like your credit card accounts are going to give you a credit score. And truthfully, why are they different than what we actually pull? So as you see here, there's with FICO, which is what we all use in the lending world to obtain credit on you. We have listed here. We have the most widely used versions, FICO 8 versions that people are going to use for getting a car loan. It could be different. They use 8, 2, or 5. In mortgage lending, we're going to use a different scoring model, and it's going to be slightly different than some of these other ones, but they're going to be vastly different than Credit Karma, and that's because they use something totally different than FICO, and they use what's called Vantage 3.0. So it is not going to give you a true estimate of your exact credit score. It's great to have an idea. What those programs are really good for is they're going to tell you what is on your credit, whether you have late payments. They're going to show if you got credit out there that you don't know about or addresses. They're going to help you kind of look at that. If you have looked at your credit and you think your credit score is too low, first thing you want to do is talk to someone, and someone's going to set you up and get you working on your credit. Right here, there is, whoops, wrong slide. Right at the bottom of this, there is www.myfico.com. You can actually get in there and find out what is going to make up your credit and kind of how to work on it. Now, working with a lender that does work on credit repair is going to be very beneficial to you as well. What we're going to be able to do is we're going to see what's on there and see if there's anything that we can do. If there's nothing that we can do, then we can trade you off to an actual credit repair specialist that's their only job, and they can really delve in and help build up your credit. Steps that you can do that I would certainly help you with is, things that you can do to improve your credit score. Things that will hurt your credit score are stuff like not having a credit mix. So not having installment loans and revolving or credit card debt. Making sure that you have multiples of those. The relationship of your credit card balance to your limits, that's an important factor. That makes up 35% of your credit score. Things that you're not going to want to do is you're not going to want to close out any credit cards that you have that are long credit cards or old credit cards with great histories. Things that are real simple, and this, as of July of this last year, medical collections. If you have medical collections that are on your credit report, if you can pay those off, those will actually be, once they've been paid off, they will then be automatically deleted from your credit bureau. So that's something that can help improve credit. I had a client that had about $1,000 of medical bills that were in a collection account, and she was able to pay those off, and her credit score went from a 550 to a 675. Went from marginally being able to qualify to absolutely we can qualify you just by doing something simple like that. But if you have other collections out there, non-medical ones, getting a game plan in place to figure out how you can get them removed and talking to a lender that can help you figure that out is going to be something that's important. Of course, you want to make sure that there's no errors on your credit report. You want to make sure that there's no old addresses. You really only want to make sure that you have your current name. Most of the time, you want to make sure that you have just your most recent address listed on credit. That any of the old addresses that you may have had in the past is updated to just your current, because that can also help fix your credit a little bit or help improve it. And making sure that everything is updated accurately. So if there's anything that's reported negatively, you want to make sure that you get with someone who can help you facilitate talking to the places that have the inaccurate credit information. This section's a little long, so we'll keep going through and get to the questions. Other important mortgage information to know: what makes up a mortgage payment? Well, we talked a little bit about this. The total mortgage payment is going to be made up of principal, and that's the amount of money that you're going to borrow and you're going to receive from us to buy that home. Interest is going to be the interest that we're going to receive as a fee for the privilege to borrow the principal above. Every home is going to need home insurance. We're going to need protection against fire, theft, other weather-related items. And you're going to want to make sure you have that. Property taxes, that's something that's out there. Everyone's going to have that. It's in a tax on the assessed value of the property. It's something that you're going to be paying to help support the schools, police, fire department, the infrastructures of the local government. Mortgage insurance, some people call it PMI, but mortgage insurance is just a privilege to buy a house with not having to put 20% down. If you have more than 20% down, you may not need to have mortgage insurance. And it's really a protection for us that if we have to start foreclosure, it's going to pay a portion of our expenses that we're going to incur during the foreclosure process. If you buy a condo, you're going to have condo association. Some homeowners, they have HOAs, or homeowners association. You may have annual dues with them. Most of the time, the homeowners association dues are fairly low, but it's really to help maintain and improve the properties within the association. If you're determined to be in a floodplain, flood insurance may be needed. And flood insurance is going to cover against damage from a flood, where regular home insurance is not going to cover that. Paying discount points. This is something that may not be a bad thing. Discount points are points that you're going to pay to lower your interest rate. It's going to increase your closing costs, but it's going to allow us to lower your interest rate down, which in essence is going to allow us to have a lower mortgage payment, less interest that you're going to pay. The points are going to let you make a trade-off between your upfront costs and your monthly payment. By paying points, you're going to pay more upfront. You're going to receive a lower interest rate, therefore less payments over time. Lender credits are going to be the same thing as discount points, but work in reverse. You're going to pay a higher interest rate, and then we're going to give you money to help offset your closing costs. When you receive a lender credit, you're going to pay less upfront, but you're going to pay more over time because of the higher interest rate. Things to start thinking about and not do. Things not to do while in the mortgage process. You definitely don't want to buy or lease a new vehicle once you're in the process. So just chatting is not in the process. Once we have you pre-approved, these are going to be the things that you don't want to do. You don't want to quit your job, start a new company, change industries. You don't want to quit your job and go into business for yourself. You don't want to switch from a salary or hourly job to a commission-only job. You don't want to deposit large sources of money, large sums of money that can't be sourced. So we talked about that with cash. You don't want to deposit cash into your bank account. You don't want just someone giving you $500 to deposit. You don't want to get gifts from people without filling out the gift paperwork. You don't want to open new credit cards. You don't want to make big purchases on those credit cards. You don't want to forget to pay your bills, even the ones that you might be disputing. Don't close out any credit accounts. Don't spend any money that you have set aside for closing. And the biggest one is don't co-sign for a loan for someone. The debt will change your debt ratios. That will help you qualify for loans. So if you co-sign for someone, it is possibly going to impact your ability to buy. But if circumstance dictates that you need to do any of these options, always talk to your loan officer before you do anything. Any questions on this long section we just went through? Okay. Like I said, if you want to set up a meeting with me, just click on my calendar link, or you can email me. If you want to get a copy of this, please feel free to send me an email, and I'll send you a PDF version of this that you can go through. All right. Last thing we're going to go through tonight. What are the next steps? Next steps, obviously, if you want to set up a meeting with me, give me a call, send me an email. We're going to make a first call. It's totally free, no cost to you. There's no credit check or anything like that. We're just literally going to sit down and discuss what your mortgage options are, what your goals are. I want to know what you think you can afford to spend. I want to talk to you about the different loan programs in greater detail that you might fit into. We're going to talk about your income. So we're going to want to know that. We're going to talk about your debts. So have an idea of what you have for debts on credit. And then we're going to discuss what you think of your credit profile. With this information, I can do a quick hand math calculation, and we can talk about different mortgage options that will work for you and see what you qualify for. Top 5 reasons to book time with me. If you have any questions that you didn't get answered here in chat, if you want to understand your personal mortgage options, there's a lot of options out there. It's very confusing. My job is to narrow it down to help you understand and to get you into the right program that's going to save you the most amount that you possibly can. If you have any concerns on your credit or finances that you think are going to be a hurdle to obtaining a mortgage, and you need an answer, even if you don't think you're ready to get a mortgage right now, obviously I recommend having a chat with me and booking a time, because we can talk about things that you can get prepared for getting a mortgage, or we can just talk about your credit. I mean, that is something that I have no problem discussing with you, even if you're not really in the market for a mortgage at this time. Of course, another reason, you really want to get a formal pre-approval. And then, of course, you talk to another lender out there and you'd like some clarifications on some of the things they told you or asked you for. Certainly give you some free advice on that. To book a time with me, you're going to go into my calendar. It's right there listed. I have it in chat as well. Of course, you can email me. Give me a call at any of my local numbers. I have a local office in Madison and a local office in Brookfield that I work out of. So please feel free to call me at either one of those numbers. Does anyone have any questions on anything, even stuff that I maybe didn't cover in this? Did you have a question specifically about credit? Please feel free to type it in. We are getting to the end of the webinar. Again, there's my QR code for my contact. But if anyone has any questions, please feel free to put it in chat and I'll try to answer it. We got plenty of time here. Anna, yes, you can have multiple people on the mortgage. That is called co-borrowers. And so you can have multiple people on a mortgage. Of course, everyone does have to meet the criteria for the mortgage. They have to be credit qualified, income qualified. All the things that we talked about, we were going to have to look at with them, but we can have multiple people on the mortgage. I've had 5 people on a mortgage. I had a family, 3-generation family that I had 5 people on a mortgage. So you can have a plenty of people on a mortgage. That really isn't going to help qualify you credit wise, but it's going to help qualify you with income. So what a person is going to do if they're not planning on living in the property with you, if they're planning on living in the property with you, doesn't matter. But if they're not planning on living in the property with you, then we call a non-occupying co-borrower. So if you have a family member, like a parent, aunt, uncle, we can certainly add them, and we would just include their debts and their income and their credit. The biggest thing is they're not going to help credit qualify you, like I started to say. So we are going to look at everyone's credit and we're going to say, okay, based on credit scores, these are the programs that you're going to qualify for. But of course, they will add income, which can help afford you more of a house. Any other questions? Anna, good question. Very good question. So there's 2 ideas on that, and that's something that we could get into greater detail and chat about. But basically, to buy before or after you get married. That is going to be credit driven. So if you do it before you get married, then we're only looking at the person that applies credit debts for qualifying. Of course, we're only using their income for qualifying as well. So if one spouse has good credit and one spouse has really horrible credit, and I say spouse, significant others, let's change it to that, has really poor credit, but has a lot of debts out there. If their poor credit and your good credit come into play, what we're going to do is we're not going to be able to add them to the mortgage, which means we're not going to be able to include their income. But once you're married in the state of Wisconsin, we live in a marital property or community property state. So once you're married, your spouse's debts are now your debts. So we have to include their debts in your debt to income ratio. So it's confusing. The best thing to do is let's chat about it. Let's schedule a time, chat about it. And what we can do is we can take a look and get a snapshot of where you're at and make the decision. And I'm not going to tell you whether to get married or not get married, but we'll say, okay, if you buy a home before you get married, this is your qualifying dollar amount. If we wait until after you're married, this is your qualifying dollar amount. It may not change anything. It may be a bonus. You guys may have very similar credit. We don't know that, but until we actually get that snapshot and get that calculated, it's definitely maybe not. I've had situations where they both ways worked out better. I had a client that wanted their spouse had a lot of debt, didn't make a lot of money. Once they got married, we had to include their debt, and that stopped them from being able to buy. And then I've had times where it's just better to have it after you're married. Now, of course, titling and ownership, once you're married, the property is, if it's a primary residence, in other words, you live there, once you're married, it becomes the property of both spouses. So both spouses get title to the property, ownership of the property, and both spouses, just because I said marital property, community property laws, they are now obligated to the debt as well. It doesn't help or improve their credit or hurt their credit if you don't make payments, but once the marriage happens, the primary residence, homestead is what that's called, becomes their property. Other questions? All right. Get another minute or two. All right. Is there a big difference between buying rural land and already built? I am not sure exactly what you mean, but let me try to ask this and then just put in the chat. Is this what you mean? So do you mean buying land that doesn't have a home on it? And then, or buying a property? Okay. So I would call that just land. So buying land and then putting a home on it. Is that what we're talking about? Versus already buying a home with a land? Okay. Thank you for clarifying. So buying land is a little bit different than buying a home that's already on the land. Generally speaking, the main types of mortgage loan programs that are out there are going to be based on homes that have properties on them. Now you could buy the land and then build on it, and then a mortgage can be done on that. There's different options for that. There's something called a construction loan, if that's your intent. But if you just intend to buy the land and not put anything on it, that's really not something that we delve into. But already built,
1,000 times easier to do, a lot easier to qualify for, but there are options, and there are options that I have for all the difference. I myself am literally, I just put an offer in on some land. I want 40 acres because I'm going to build a house on 40 acres. And we just put an offer in and we're going to build on it. So I am doing the first as well. But it's very in depth. So there's a big difference. No, a difference. Yes. Working with someone that is going to know the differences and how to really effectively work it for you is going to be the best option. And you know, we can certainly discuss construction loans. There's multiple options that are in there. And if I didn't answer your question, I apologize. Any other questions, people? Okay. I'll wait another minute here. All right. Well, I thank you for attending the Midwest Homebuyers webinar. 5 money mistakes that you make. Hope you have yourself a great rest of your day. And hopefully you don't have to do a lot of shoveling. I did today myself. So have a great rest of your evening. And please feel free to reach out to me with any questions. Okay. Thank you. Bye now.